A lot of people treat their bank account like a slow cooker. You set it up in your 20s, automate your direct deposits, and check in occasionally. It feels like a responsible, low-risk strategy. But mathematically, treating a standard checking or savings account as a set-it-and-forget-it safe haven actively costs you money. Right now, the national average annual percentage yield, or APY, which is the real rate of return earned on an investment taking into account the effect of compounding interest, for a traditional big bank savings account sits around 0.01%. Meanwhile, the top high-yield savings accounts, or HYSAs, are paying between 4.20 and 5.84%. This graph shows how that gap plays out on a $100,000 balance over a 5-year timeline. At a 0.01% yield, your money earns about $10 a year. At 4.20%, that same balance earns $4,200 in a single year. The risk profile for both accounts is identical. The effort required to maintain them is identical. Yet, the vast majority of savers leave their funds in traditional accounts, earning effectively zero. The cost of doing nothing here is a specific, measurable penalty. It is an inertia tax levied directly on your reluctance to move your money. When you leave cash sitting in a low-yield account, you are providing your bank with highly profitable leverage. Banks take those stagnant deposits and lend them out at much higher interest rates, paying you virtually nothing in return. From the bank's perspective, your inactive money is the cheapest form of funding available. Stable, predictable customer deposits are exactly what allow them to generate massive margins. The entire system hums along smoothly because banks rely on a simple assumption: you will not pay attention to shifting interest rates, and you will not take the time to optimize your own funds. Customer loyalty in traditional banking rarely translates to better terms. Instead, long-term predictability is treated as a highly profitable liability that the institution actively exploits. Behavioral economics explains exactly why we stay put. The human brain operates with a heavy status quo bias. We naturally prefer things to stay the same, interpreting the act of switching banking relationships as a disproportionately high risk. This is compounded by loss aversion. We weigh the immediate, perceived hassle of researching and opening new accounts far more heavily than the mathematical gains we would earn by switching. Financial researchers call this the zone of indifference. It is the psychological threshold where small price changes or minor rate bumps simply do not motivate human action. Specifically, studies show consumers typically need at least a 50 basis point jump to care enough to move their money. A basis point is a unit of measure equal to 1/100th of 1 percentage point, meaning 50 basis points equals 0.5%. This chart shows the absurdity of the current market. The psychological trigger requires 50 basis points. The actual gap between big banks and high-yield savings accounts right now is over 400 basis points. The current reality completely shatters the standard zone of indifference. Traditional banks base their low rates on outdated consumer psychological barriers. In today's interest rate environment, staying put is no longer mathematically justifiable. The reason legacy banks pay 0.01% is structural. Maintaining a massive physical branch network, paying thousands of tellers, and running legacy IT systems requires enormous overhead. Online-only banks do not have that overhead. They save millions on real estate and staffing, allowing them to acquire customers aggressively by passing those exact savings directly to depositors in the form of higher APYs. Choosing not to optimize your rate introduces a macroeconomic threat. Inflation is the continuous erosion of your purchasing power over time. As the cost of goods rises, the actual value of your uninvested cash drops. To measure your actual wealth, you have to calculate your real returns. This is the growth of your money after you subtract the current rate of inflation. If you hold a 0.01% APY account during a period of standard inflation, your real return is negative. The math guarantees that your money is actively shrinking in value. Leaving your money in a low-yield traditional account feels like a safe, neutral action. In reality, it is a guaranteed strategy for losing wealth over time. The primary anxiety keeping people at legacy banks is the fear that online, branchless institutions are inherently riskier or more susceptible to failure. The absolute structural equalizer here is FDIC insurance. The Federal Deposit Insurance Corporation and the NCUA for credit unions are independent government agencies that legally guarantee your deposits if the bank fails. The exact terms apply across the board. Your deposits are protected up to $250,000 per depositor per institution. The physical presence of a marble lobby has zero bearing on the safety of your principal. The perceived safety of a physical bank building is a costly illusion. Both online and legacy institutions share the exact same federal guarantee. This matrix compares high-yield alternatives to big banks. An HYSA offers total liquidity, but has a variable rate that drops when the Fed cuts rates. A CD locks in a fixed rate, shielding you from cuts, but you completely sacrifice liquidity for the term. That lack of liquidity is strictly enforced. If you need to access your funds before the CD term ends, you trigger early withdrawal fees that can wipe out the interest you generated. Your choice is not about finding the absolute highest rate. It is a calculated trade-off between immediate cash access and long-term rate certainty. This flowchart shows an allocation strategy based on timeline. For emergencies under a year, use an HYSA for instant access. For fixed goals up to 5 years, lock in a CD. For daily transactions, keep a traditional checking account, but automate transfers to high-yield accounts. Executing this strategy requires opening an account and initiating an ACH transfer, the automated electronic network used to move money between banks. The entire process takes roughly 10 to 15 minutes of input on your phone or computer. The math is clear, and the federal protections are identical. Overcoming 15 minutes of behavioral inertia is the only thing standing between you and thousands of dollars in compounded returns.